Hey, what's up, everybody? Kendall here with the Wealthy Legacy Journey, and today I'm bringing you another book report, another book by Robert Kiyosaki. This one was so good. It's in the Rich Dad series, Why the Rich Are Getting Richer. And he has this other question here. What is financial education really? And man, this book was powerful. One of the big things, actually, just even reading the back, like it really does summarize the book so well. What did school teach you about money? This book is about what school did not teach you. And he really does that. Like this book is all about um, going into what is financial education, what is financial literacy, right? And so it kind of is the next level of the Rich Dad Poor Dad book. So if you haven't read Rich Dad Poor Dad by Robert Kiyosaki yet, definitely read that one. But then I would definitely recommend checking out this one next because it's been so good. He talks about the difference between saving for the baby boomer generation and what you could do with your savings versus what savings does for us today and what that looks like. And really how making money is different today, being able to earn money, being able to invest money, being able to build up a retirement fund, being able to build up a wealth snowball. It is so much different today than it was for the baby boomer generation. And anyways, I have broken this book up. Well, I should say it wasn't me. Robert Kiyosaki broke this book up into a couple different parts. And what I did, and I'm just trying to, again, with these book reports, figure out what's a good way to go through these books. I just kind of broke down what I felt like were important tidbits out of each of the parts. And then he also has an intro and a lot of stuff in the outro. And this book was it was amazing. I really enjoyed it. I couldn't even tell you which I enjoyed more, Rich Dad Poor Dad or this one. They were both great books. There was so much information, so much richness here. Some great stuff. So I'm going to go through here. I'm just going to kind of start by flipping through a couple of the initial pages and just kind of reading some of the stuff that I highlighted from the introduction. Um, but what I found to be powerful, this was interesting. Go to school to get a job. When a parent says to a child, go to school to get a job, they're advising their child to be a proletariat, someone who sells their labor for money. An employee does not own their production. We're talking about active income, not active investment income. There's no investing there, it's just active income. It's just an investment of time. And they're trading time for money, right? If the child finds a high paying job, they join the, I'm not even trying to pronounce the word, Borgos. I'm probably totally mispronouncing that word, and become a middle class person, happy with material trappings such as a college education, house and car, comfortable being comfortable, keeping up with the Joneses. Most of them have a high paying job. Um, some are self employed specialists, such as doctors and lawyers or small business entrepreneurs, but they do not own the real estate or the production. These people still work for money. But then he has another section over the rich do not work for money. In other words, our educational system, proletariat and Borgos, rather than capitalists, the people who own the land, the businesses, and the capital. Um, and it was just so interesting. Just kind of even this opening here. Um, Man, this is so good. I even made a note here in reference to Ray Dalio's The Changing World Order about the changes of civilizations over time and some of the correlations that he was making to some of the things that I've seen in Ray Dalio's stuff. As stated in this book, people get into financial trouble calling their liabilities assets. For example, they call their house an asset and their car an asset when they're really liabilities. Why are they liabilities? Because they're taking money out of your pocket. They're not earning you money. Really, this book was all about building and creating and sustaining a financial IQ, learning how to think about money and learning really just how to think overall about investing. And so I am going to part one was why the rich get richer, why the rich are getting richer, excuse me. And there was a couple of great chapters in here, but I am going to flip over to my notes that I put together for us. Let's see if we can kind of consolidate these first few chapters. So some of the big takeaways that I had were stay out of the E, that would be the employee, and the S quadrants, the self-employed. Another note: the only people who will make it through this time of just instability that we're potentially facing moving over the next few years, with being financially intact, are those with true assets, not with hordes of cash, because there's a lot of stuff going on with cash. He even talks about the danger and some of the dangers that we face with the petrodollar, which on a global scale is, as I've been reading in different reports and articles and stuff, is even more negatively affected by the creation of BRIC, which is oh goodness, it is well, I forget what B is, and then there's Russia, India, China, Brazil, Russia, India, China, coming together to actually exchange oil and currencies outside of the dollar. And basically, the dollar was on the gold standard, but then they removed the backing of the gold standard. They started removing it in the early 90s, and they completely removed it in the 1970s. I can't remember exactly which year. They completely removed the dollar off the gold standard. The thing that's kept the dollar powerful on a global scale, though, is that the only thing that oil has been able to be traded in was in United States dollars. And so it's almost as if instead of having a gold backed currency, you had an oil backed currency, in the sense of the only thing that you could trade oil for was for dollars. And so the value of oil was kind of like, it was, I don't know, it was propping up the value of the dollar. But if people don't have to trade oil in dollars anymore and they can trade oil in other currencies, well, that leaves some question marks around how strong is the USD. And especially my home country of the United States, it kind of makes you think about, well, where is the safest bet on where to put my money? Is it in cash, or is it in assets that actually hold a true tangible value? What truly is the true tangible value of dollar if it's not backed by gold, and it's now becoming threatened to where there's other currencies that are able to be traded for oil, and oil can be traded for those currencies. I'm not to say whether one's right or one's wrong. What I am saying is, if we look at it, does these facts of what we're facing right now put the United States dollar at some risk? What level is that risk? And then how do we hedge against and mitigate that risk? And that's really all where the financial education comes into play. This is more of like an awareness, is one of the things that he was talking about here. But then you have to build financial education to go, okay, well, how can I hedge my dollar against a loss of value? So a great way to think about it is what goes up when the dollar goes down. That's why there's been a ton of noise and a ton of talk about gold recently, because gold has been a historical hedge against the devaluation of the dollar. So as the dollar goes down, typically the value of gold goes up, or at least can remain relatively constant. And so in that case, gold may be a safer storehouse. Now the problem with just bricks of gold, is that they can't actually produce cash flow in and of themselves. They just get stuck into a vault and they sit there. Um, so, and this is kind of a tangent, just for ideas. I was actually, my mentor for stocks and things of this nature, Andy Tanner, was talking about how Warren Buffett had actually made a trade, on he actually purchased a portion of a large gold mining company when he was concerned about the USD. And I guess Andy Tanner said at the time of that recording, then he had exited that position. But the reason that he entered a position on a gold mining company was because the gold mining company was producing value, and I believe they were also paying a dividend, if I remember correctly, and I can't remember the ticker. Um, but they were paying a dividend. And he said that if the value of the dollar goes down and the value of gold goes up subsequently, well, what is that? What is the gold mining company going to do? They're going to start mining gold as absolutely fast as they can, because gold has now become incredibly valuable, which means the value of the company will go up, especially as everybody starts racing towards gold and anything in and around gold, including gold mining companies. It'll probably overinflate the value of the gold mining company. And that gold mining company will pay dividends that are likely to increase greatly, even though your original investment on what you paid per share will likely not increase that much. And so that was just a really interesting way to be able to play the market. Warren Buffett said, hey, instead of just buying a bunch of gold to stick into a vault, what if we bought shares of a gold mining company, got paid dividends, but still had the same benefits of the increase of value of gold through this vehicle of the gold mining company? So just a really interesting way that wasn't actually in the book about the gold mining company, but it's just a portion of getting your mind in the right place, which is all what we're about here at the Wealthy Legacy Journey. He also talked about how mistakes are good if you continue to fail forward, right? So, for example, with me, I have, as you guys know, I've lost $100,000 in investments twice, but I'm still at it. I'm still moving forward. And now we actually have double dare your money. We're going from 0 to 1,000, and 1,000 to 10,000, and 10,000 to 100,000. That's been my threshold point. I've struggled to move from that 100,000 ish mark to the $1,000,000 mark. That's been my speed bump. Well, I really broke it down this last week, and I'm super excited that we're doing the Double Dare Your Money because it's giving me it's even given me a lot of clarity and insight for how to effectively make that transition over the $100,000 hurdle on the way to the $1,000,000 hurdle. And then there's going to be another hurdle at 1,000,000. We're going to figure that out together. But that's what I'm excited about. We're doing this as a group. We're doing this as a community. You guys can do this with me on Double Dare Your Money. It's going to be great. Robert Kiyosaki also talked about when the market crashes, don't run away. This is like as if the store had a massive discounted sale. Who would run away if the store came out and said, hey, everything is 90% off. We're having a huge store-wide closing sale. Everybody would run to that sale. But when the stock market, when Wall Street has a 90% off sale, everybody runs away. He said, instead of running away, buy everything. Buy absolutely everything that you can. I actually read this Wall Street quote one time, and it said, buy when there's blood in the streets, even if it's your blood that's in the streets. And I thought that was really interesting. So like even if we were to have a market crash, and even if you were to take some heavy losses when the market's down, don't let the fact that you just got burned drive you into a scarcity and fear mindset. Buy up as much as you can while it's at the bottom, because everything is heavily discounted. Now, do it wisely, right? If you go through Andy Tanner's stuff, go through that fundamental analysis that he talks about as one of the peers of solid investing. Go through and do, really good, rigid technical analysis. Understand the risk behind the trade. Take positions wisely. If you're looking at it from a stock market approach, if you're looking at it from a real estate approach, understand the value of the market, right? Understand what can you liquidate properties at? What is the value that a house can be sold at in the current market conditions? Make sure that the market isn't super saturated to where you won't be able to sell, or if you're gonna have a rental, make sure it's not super saturated with rental. So always be wise in those decisions. But there, in a case where the market goes down, the amount of opportunity goes through the roof. So don't run away scared. He also talked about how over diversification is ultimately there to make up for a lack of competence, right? The more diversification that you have, the less competence that you have. And you're just trying to make up for a lack of understanding of the market and the dynamics. You're saying, well, if I throw enough darts at the dartboard, eventually I'll hit success. And that's really gambling more than it is investing. And he heavily advises against that, especially in the financial education literacy. And it was interesting. He even talked about how it was very intentional incompetency in the case of CDOs, collateralized debt obligations, the thing that crashed us in 2008, where you had layers and layers, I call them tranches, but layers and layers of bad debt that nobody wanted to touch. And if you put enough of these bad layers where people didn't want to touch the individual layers because they were so nasty, well, you put enough of these layers together, you basically have 100 layers of bad debt that nobody wanted, but because they renamed it and they restructured it differently, people said, oh, it's real estate. I want that. And they created all these really terrible CDOs. He also went into how the war in Iraq and 9/11 was really a whole bunch of it was to keep control of the petrodollar. And he backed that up by facts and some really bold statements, but backed it up with facts and reasoning. And the fact, of everything that's been going on has really been to keep control of the petrodollar. And the reason that the U.S. fights to maintain, some of these were gotten to my own thoughts based off of what he said. But the reason the U.S. fights to maintain the petrodollar is because it's the value of the oil and the fact that it can only be bought and sold in the United States dollars that keeps an overprinted and overdistributed, really overcreated USD worth even the paper that it's printed on. So that leads us into part two. In part two, the title here is What Financial Education is Not. And so he said that financial literacy is not learning how to be a good middle class worker bee. So again, I shouldn't say he said this. He said some things that stimulated thoughts. I just generated my thoughts here. So I'm just extrapolating thoughts from what he said. I don't want anybody to think I'm quoting him because I wrote my notes here at the end of each one. I just lost the placeholder. Hopefully we're going to be able to get back to that. Let's see, that was probably somewhere in the back. Anyways, financial literacy is not learning how to be a good middle class worker bee. It's learning how to think and grow rich. It is a language all of its own, reserved for those who seek it, who come to think about it. It might be, I said who seek it, and come to think about it, it might actually be wisdom's cousin. And just this language that's spoken. And we search it out. And it's really all about immersing yourself. Like I'll tell you guys right now, as I'm very much in the beginning of my stocks and options training with Andy Tanner, there's so many things that him and I believe his name's Noah Davidson say in the course that I'm going through. And there's a whole bunch just like way over my head. But I'm immersing myself in the language. I'm immersing myself in the thoughts and the way of thinking and the getting in the right mindset so I can get my brain to think the way that their brains think. Another thing to know is that overprinting of money always leads to hyperinflation before it's game over. So for anybody even thinking about investing and thinking about, do I hold cash? Do I hold assets? What's the best play for me here? If the United States government starts to print money like crazy, or if the petrodollar ceases to exist and other countries no longer need United States dollars in order to be able to get oil and they start sending money back, creates the same effect as printing money, right? Because a whole bunch of USD enters the American economy, enters circulation. What's going to happen? Well, there's a whole bunch of dollars and there's the same amount of materials as there were before. The price of those materials are going to go up because there's a supersaturation of dollars. And so the value of the assets will go up while the price of the dollar goes down. It's interesting that he noted that the U.S. is becoming less educated as a nation. And if you look at Ray Dalio's The Changing World Order and you go and watch that video, he also has a book on it. I haven't gotten a chance to read it yet, but I will. It's interesting. He talks about how the lessening of education over generations is one of the signs of major weakening of a country. Another note is financial literacy causes many problems, but there is also a proven path to financial literacy, to gaining financial literacy, that has the opposite effect. So all of us have the opportunity to gain financial literacy, to gain financial understanding, to start walking in the right direction. The wealthy focus on building assets, but the middle class, they focus on building up and managing liabilities. So, hey, can I hold all these credit cards? Can I hold this car payment? Can I hold this house payment? How do I keep all of this up and how do I juggle all this at the same time? That's what the middle class thinks about. But the wealthy thinks about, how can I buy an asset that is going to be able to pay for the liabilities itself so I don't have to pay for liabilities? That's a really interesting question. Assets put money into your pocket whether you work or not, whereas liabilities take money from your pocket even if they go up in value. So the home that you live in might go up in value, but it's still taking money out of your pocket through mortgage, through property taxes, right? And so that makes a liability. It's not until you take that home and you rent it out and now it's creating cash flow that becomes an asset to you. It can go up in value. It's also putting cash in your pocket. Even a note from the real estate side of things, I can't tell you how many times that I talk to people who get in a tight spot, even though their house is worth all this money. The problem is, if they go to sell their house that's worth all this money, they still have to be able to have somewhere to live. So they're either going to have to downsize so they can take part of their equity and then use the other portion of their equity to put into a new house to live there and downsize, or they're going to have to take all their equity out and then go rent something from somebody and be paying into their equity. And so often I see this firsthand where people consider their house to be an asset, but the problem is it's not an asset that you can tap into without taking the roof out from over your head. Whereas if you have a rental property, well, you can then sell that rental property, but you get to keep your house if you need the capital gains, or you can have the cash flow over time and not worry about the capital gains. So that's part two. Part three, and again, this is like little drips of information out of an amazing chapter. I mean, there's so many things that I highlighted here. He talked about the crash of 1929 and the stock market crash. He asked a whole bunch of questions. I mean, almost every single page, I would say at least every 3 or 4 pages, if not every other page, I have underlines in that part. Part three, what is real financial education? Again, going back to this concept of over diversification is simply a poor attempt of compensating for a lack of competency. He mentioned this again, that the key to investing, it's not luck and it's not being spread super thin. So hopefully some of them work and some of them, even if some of them don't work, it's about making wise investment decisions, having understanding about where your money is going. It is your job to be in control of your money. And I know that learning about investments for some isn't always the most fun or sexy thing in the world. But the thing is that it's your job to learn how to take care of your money. Even if you don't become a proficient hedge fund investor and you're investing money for other people, you at least have to know how to make these decisions for your own money. Tax codes, they favor the businesses and the investors while they punish the employees and the self-employed. As an employee and self-employed, I see this. Self-employed, you definitely pay less than you do as an employee in taxes and Social Security and all that kind of stuff. But I've really started to get a good understanding, especially in this book, for how tax codes really do favor large businesses and true investors. If you can't explain it, this is something you talked about whenever you're talking about like different theories and different things that we learn. If you can't explain whatever it is that you're trying to teach or you think you understand, if you can't explain it to a 6-year-old, you don't truly understand it yourself. And so the thing is not only do you need to be able to recite some of these financial education lessons, but you have to be able to actually understand these financial education lessons to a place that you can explain it to a 6-year-old. There's a lot of things that I can't explain to a 6-year-old, so I don't necessarily have even close to all understanding of investments. But there are a couple things, and every single day I go through, my financial education expands. Every episode that I record, it causes me to recite these things, and my financial education expands. Every book that I read, such as Why the Rich Are Getting Richer. Every time I read one of these books, my financial education expands. When I go through the Andy Tanner course, or I go through the Cash Flow Academy, or if I go to Russell Brunson's 2 Comma Club, or if I go to way back in the beginning in my real estate career, I went to a guy, Cody Sperber, and I can't remember what the name of the group was. But every time I go to one of these mentors courses, I hope you guys are getting this as you're listening to the Wealthy Legacy Journey. Your financial education and literacy expands, right? And I would highly encourage you guys to go read these books. He mentioned over and over, focus on portfolio income, focus on passive income. Do not make the main focus of your life focusing on how to build more active income, right? So portfolio income, passive income. So we call that in our group active investment income and passive investment income, right? To break that down again, you have active income, which is trading your time for money. You have passive income, trading nothing for money. So the active income is like a job. Passive income being like Social Security or a pension or something like that, where it's like you worked at one point, but now you're not having to do anything and you're just receiving a free paycheck for what you did in the past. But then active investment income is trading your time and money for money, and passive investment is trading your money for money. So it's always better to have a sure footing by trading something for gain. The ultimate trade is trading money for more money, where your money goes out there like a worker bee and it makes more money for you without you having to do anything yourself. That's the highest level of investing. It's a level that I haven't really gotten to quite yet, but I'm working my way there. I'm very heavily involved in the active investment category. And as you guys know, since I have a job right now, I also have active income, but it's not anywhere close to the main focus of what I do. It takes a large amount of my time because I do have 40-hour a week job, but the investment that I do, the investing that I do, that is a high priority in my life. He talked about using other people's money. He talks about using other people's money in a sense of debt and talks about that with depreciation. He talks about how huge this unseen income is and what a great portion it is of the wealthy. He gave this amazing example of McDonald's on page 169. I'm going to let you go read that example of McDonald's on page 169. But it was crazy. Again, he talked a lot about debt. I'm still trying to figure out how I feel about debt. But he's made some very powerful arguments. I'll say that. And I think it's healthy to be able to see both sides of the coin, right? I can see a Dave Ramsey side of the coin, but I can also see a Robert Kiyosaki side of the coin. And so now here I am standing on the edge of the coin trying to decide, okay, I've seen both sides of the argument here. How do I come to my own educated decision? I'm not going to go with one or the other just because they said so. That's not a financial education. I need to have my own why reason for the decisions that I make. By the way, if you want to read this McDonald's analogy on page 169, just a little plug for the Wealthy Legacy Journey, make sure that you go to the description in the top of the video, to the top of the description in the video, top of the description in Spotify. Click on the link to go to the resource doc, or maybe one day it'll be the website, and you'll see a whole bunch of lists of books and videos and all sorts of stuff that we've recommended here at the Wealthy Legacy Journey. Included in that list will be why the rich are getting richer. There's going to be an Amazon link there. And if you use that Amazon link, you will be able to go straight to Amazon, purchase this book. It doesn't cost you any extra to use that Amazon link, but we will get a little bit kickback here at the Wealthy Legacy Journey for you purchasing through Amazon using our link. So if you're thinking about buying this book, I would greatly appreciate it if you use our Amazon link that is in the resources page, is on the resources page. I may even add it to the description too at some point or another, but I know for sure it'll be in the resources page. Go there, click the Amazon link. It'll take you to Amazon. You'll pay the normal amount that anybody else will pay on Amazon, but we'll get like a little bit of a kickback off of that. So anyways, it's my one little sales pitch for definitely get the book, but if you wouldn't mind using the Amazon URL that we put out there, that would be super cool. I really appreciate it. This is a quote. He said, "Your life transforms when you learn to love what you fear." And he was talking specifically about sales in that context there, and about pushing through the hard and learning how to be good at sales. Speaking of sales, an entrepreneur must learn how to sell. Another note that I took, this was so real. He said, the S quadrant hell is real and it is painful. And I put a note in here for myself, just keep going. Making that transition from self-employed into the business and investor is so difficult. And that's really why I've put together Double Dare Your Money in the way that I have, is it allows you to skip that like early business, I don't know what I'm doing kind of deal. It allows you to jump straight into small time investing, flip up for capital gains. Eventually we'll build to a point where we have cash flow, and then you can do whatever the heck you want to do and just love doing whatever you want for the rest of your life because you're making everything that you need to live. And then you can go start a business. And if it takes off, great, you have even more income. If it doesn't take off, that's just fine too, because you're supplying your daily needs through passive passive investment income, maybe some active investment income as well. So anyways, another little plug there for Double Dare Your Money. Masters of money can turn simple ideas into money. That is so powerful. And I'm not saying that I'm a master of money by any means, but I want you guys to notice, I took this idea of the Wealthy Legacy Journey and I just came on here on YouTube and I put some time into it. And a lot of this is for my kids, but also for anybody else who feels like they might be able to get some tidbits of value or knowledge or understanding or anything out of this. But I put content out here, and as I'm putting content out here, my buddy Kane says, "Hey, what if put together a resource page for the books and the videos and stuff that you go to. And hey, what if on the books and other stuff that people can buy on Amazon, you do the Amazon affiliate links? Boom. I put a little bit of time in, don't put any money in, and I create money out of thin air. Oops, I'm sorry about that. Create money out of thin air. I create money out of thin air for doing just putting content out there. And then on the Double Dare Your Money, it's really become this idea of like, well, how can I flip my money? And in flipping my money, I could show other people how to flip their money in a simple way, starting very low and building their money up. I could do that with the Wealthy Legacy Journey. And you know what? Maybe one day I could actually create a program that people could pay a little bit to be a part of so I could get paid to put this program together for people. And I thought, how cool would that be? And so that's the beginnings. I mean, I've had so many different ideas of what I could do along so many different things, not just even the Wealthy Legacy Journey. I've had multiple other businesses that have tried and started up before this point. I even had a business in high school. But yeah, how to turn an idea into money. Another note I have here is the Middle East. Wars have been about keeping the petrodollar alive, which we've talked about in some of the other chapters. Student loans are a huge trap. He mentions that. He mentions to be very, very careful and aware of student loans and the path you're walking as becoming self-employed or active income, walking down that road. He talks about practice makes perfect, even in investing. There's no shortcuts to this, but there are ways to avoid some of the pains and to get on the right path with the right mentors. And that's why I pay for mentors. And that's why I hope that you are encouraged to go read some of Robert Kiyosaki's books, go read Dave Ramsey books, go read Jim Collins, Good to Great, get your own mentors. Maybe one day we'll have some sort of training or mentorship program here on the Wealthy Legacy Journey. We would love to have you a part of that when that becomes available. But for now, while we don't, there's plenty of other very smart, well-educated people out there who have the ability to take you under their wing and to teach you. One of my mentors right now, Andy Tanner, the Cash Flow Academy. It's been amazing. There has been so much information, but it has been so good. Another note, building a strong financial team for counsel is an important key to success. And he actually talks about the attorney that he has all through this book. Tom Wheelwright, his CPA, has a bunch of notes over the tax code and how you can use taxes to your advantage, and that being a big way that the rich get richer through leveraging depreciation and not having to pay as much in taxes. And that was really fascinating. And he talks about the power of his team. The last part 4, he talks about no fun economics. And one of the big things that I grabbed out of this part was don't sink assets to fund liabilities. And definitely don't acquire liabilities that you have to pay for. Only buy liabilities that are funded by assets. And so it's interesting. In here, he has an example of how a Porsche made him richer. And he talked about how there was this Porsche that came available that he really, really wanted or something like that. And he ended up putting money. He took $50,000 that he had cash, which would have paid for this Porsche that he wanted at the time, because it was a really good deal. He put the cash into buying a storage building unit. He bought it with, I think he put like 20% down, if I remember the math on it correctly. And then he ended up cash flowing off of it enough to pay for the monthly payment on the Porsche. So instead of putting $50,000 in to buy the Porsche, he put $50,000 down on a storage unit. And then he took the cash flow off the storage unit to pay for the Porsche. He also received depreciation off of the debt on the storage unit, which is interesting. And everybody has their own taste and feel around debt. And again, I'm not 100%, I'm not selling that you should use debt. This is just a really interesting example to learn from. And then a couple years later, he was actually he ended up selling the storage unit place for a really strong return. So in that case, don't take your asset of even cash and just dump it into a liability where you don't have that cash anymore. That doesn't really help you in the long run, because even the value of that car is going to go down over time, whereas the value of the storage unit place went up. He also received value from the depreciation. He also received value from the rent payments. And definitely don't acquire liabilities that you have to pay for yourself. If you have to go into debt to buy a car, that is very, very, very bad debt. But if you, and he calls this good debt, and I'm not saying this is necessarily my stance, but Robert Kiyosaki calls it good debt whenever you have debt that you put out there that is going to be able to produce you a return, such as the storage unit complex. I'm not saying there is a thing as good debt. I'm not saying there's not a good thing as good debt. What I'm saying is that is Robert Kiyosaki's argument. I'm still coming to my own conclusion in and around debt, and you have to come to your own conclusion in and around debt. It's hard for me because, I've found a lot of success in the Dave Ramsey type programs. He is very, very, very anti-debt. And so I tend to lean anti-debt. I tend to lean more towards JV partnerships, but I do see some of the points that Robert Kiyosaki is making in his book. So I'm going to continue to have an open mind, and continue to pursue and continue to be able to make my own judgments and decisions. At this time, we don't do the debt thing for investments. But if at any point that changes, I will let you know. I don't foresee that changing in the immediate future, but I will let you know. One last note, he said here, for things to change, first, I must change. And that was a quote that he actually quoted from his Rich Dad. Robert Kiyosaki quoted from his own Rich Dad and his lessons. In order for things to change, I first must change. That was like just a couple of golden nuggets out of this really, really good book. I would highly, highly recommend. In fact, you would be doing yourself a disservice if you're walking the wealthy legacy journey and you didn't read this book. That's my opinion. Definitely get this book, Why the Rich Are Getting Richer by Robert T. Kiyosaki. Make sure that you get it using our Amazon link. I really appreciate it. It'll be in the description. Definitely on the resources page, which is in the description of Spotify, in the description on YouTube. But I also might include just our direct link to Amazon in the description in and of itself, so you can get it more easily there. I'm not 100% sure on that, so if you don't see the link in the description, just go to the link for the Google Doc and grab it there. But guys, this is a great book. But I would encourage you in whatever you're doing, make sure that you're keeping your mind open and make sure that you are building up a financial education. Take control of your money. Don't let money take control of you, and grow your wealth. And just to remind you guys, as a part of the Wealthy Legacy Journey, we define wealthy as having the ability to cover your monthly expenses without having to lift a finger. I'm not talking about being multi-millionaire rich. I'm talking about being able to provide an income, a stable income for your family, even if you didn't have the ability to work. What kind of feeling would that give you to have that level of freedom in your own life? Wouldn't that be amazing? If you knew that you could work, but you didn't have to work, and if something happened to you, your family still had steady income from an income stream that would be able to come forever. Hard facts of things, when somebody passes away, their social security stops. When somebody passes away, their pension check, it stops. But any dividends that I build, any rents that I build, anything like that, if I were to pass away, Libby still has those. Those don't stop. Those assets that we acquired, she still has. And to me, that brings a great comfort. So that's why I'm focusing on building wealth for my family. And I also realize that legacy, we all are going to leave legacies. And legacy is simply just the fruit given off by the seeds that we plant. We all plant seeds in our everyday life. But good seeds will produce good trees, which produce good fruit. And bad seeds produce bad trees, which produce bad fruit. And so I'm making it a goal in my life to plant good seeds. And then I want to cultivate and prune good trees that'll be able to create good fruit for my life and for the lives of the people around me. So with all that said, go get your copy of Why the Rich Are Getting Richer by Robert Kiyosaki. Make sure you use the Amazon link in the description to be able to go get that and help us out, because we'll get paid out a little bit of a portion when you use the Amazon link. It has been awesome hanging out with you guys for another Wealthy Legacy Journey book report. Super excited to share this one with you guys. I will see you guys on the next book report. I'll see you guys on the next Wealthy Legacy Journey episode. And I'll see you guys on the next Double Dare Your Money. It's been super cool hanging out with you guys. This has been another book report, another episode dedicated to you and your own personal wealthy legacy journey. Kendell signing off. I'll see you guys on the next episode. Bye, y'all.